Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, Treasury rates, particularly the 10-year, affects almost every asset class out there. Yields on the 10-year have been creeping up higher recently, but they still remain close to historic lows. So let's talk about some of the factors that are affecting Treasury rates.
Yeah, I mean, there's a lot to unpack there, Steve. There's various factors affecting Treasury rates, but we can talk about a few. And the first and the most obvious is the Federal Reserve. We all know the Federal Reserve dropped the Fed funds target rate to 0% during the crisis, where it's remained ever since. Furthermore, they've been buying $80 billion, that's with a B, $80 billion worth of treasuries every month. And those systematic purchases create demand, which keeps prices higher and yields lower.
Yeah, Travis, and the federal debt has been ballooning during the pandemic, and all of the extra debt and interest payments in the future that America has to make is going to be much higher if these rates continue to tick up the way they are. There is an incentive, though, for the Fed to keep these rates low for the foreseeable future, isn't there?
Yeah, there certainly is, because higher interest rate payments in the future means lower growth. Yeah. And speaking of incentives, Steve, there is approximately 15 trillion, this time with a T, $15 trillion worth of negative yielding debt globally. So money or investments seeking a positive return or a positive yield are eventually going to find their way into countries that have a positive yield. And in our case, you know, the U.S. and U.S. Treasuries.
Yeah, Travis, another factor I think about is the stock market, and it's had a pretty good run this year, and it's set new highs, obviously. And in the normal course of business, in the rebalancing of portfolios, we'll be selling those stocks and moving it down into the fixed income or bond arena. And another reason, and it's another reason that is pushing the bond prices up, and it's keeping rates low, isn't it?
Right, yeah, more demand coming from that rebalancing. And,
yeah.
You know, the final factor we'll discuss today, Steve, and it's my least favorite to discuss, is political risk and then monetary policy error risk. So turn on the TV and you're anytime this week and you're bound to find a story about the infrastructure bill making its way through Congress or a fight about the debt ceiling. You know, politics right now are probably the most fractured you and I have ever seen in our lifetimes. So that creates a risk or anxiety for investors. And then there's central bank policy risk. And that's meaning that the Fed could possibly make the mistake of easing for too long or tightening too soon. And, you know, they've said recently, or Powell has indicated during the last meeting, that they planned on tapering those bond purchases, the $80 billion worth of bond purchases. But tapering isn't tightening, remember. It's just easing at a slower pace. And then they've also alluded to raising interest rates, probably starting in 2023. Many believe that that is going to be too late, given the inflation readings we've seen here recently. And many believe that might be too soon because of, you know, economic growth might stagnate by then. But uncertainty drives people to safe assets in this case, treasuries.
Yeah, Travis, that's absolutely right. I look forward to this next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.